The S&P 500 continued its winning streak yesterday, closing at a 10-month high. Short seller David Tice says upside is limited. He is the chief portfolio strategist for bear markets at Federated Investors, and he dropped a bomb this week on Bloomberg television when he said that fair value in the S&P 500 is 400. You heard it, 400. So we're going to talk to him about that. Also, some other big questions. David, we welcome you back into the studio. Always glad to have you come in.
Good to be here, Deirdre.
So let's talk about, I mean, it's a big number, right? 400. When do you think, a small number, as Eric just says, yeah, big headline number. When do you think this could happen?
Well, markets always take a long time to get there, Deirdre, and we certainly had a big rally to 1,000. We think we're going to get to 400. I probably said that a little bit quickly. Over 9 months, a year, et cetera. We think the market's dramatically overpriced at 22 times 010 earnings, according to strategist numbers. That's an exceptionally high number for the bottom of a bear market.
So let's talk about earnings then. I mean, in the second quarter, if you're saying overvalued, I'm assuming you mean earnings growth you think is just weak.
Well, earnings growth is negative, and even though we had a lot of companies beat expectations, the year-over-year numbers were down some 26, 28%. And we think earnings are still going down, and the problem is the expectations that were beat were being done at much lower levels than last year, and due to cost cutting. Revenue was down significantly.
But margins, I mean, profit margins were better than expected. And I have a note here from Credit Suisse saying that margins were better than expected in the second quarter, which suggests that earnings will benefit strongly once revenues recover. And many people are forecasting this kind of second half of the year, first quarter of next year economic growth. So that implies we could see some sales growth.
All I can say is the people that are calling for it are the ones that missed it to begin with. You know, most of the pundits, most of the strategists, most of the analysts that are now saying everything's going to be fine completely missed, you know, the biggest decline that was all due to this credit bubble. This credit bubble has been so huge in the aftermath of a credit bubble bursting, of a financial crisis like we've had. Even though we'd love it to recover quickly, you know, I'd love for prosperity to return. Unfortunately, I think you need to be realistic, and it just takes time to work off these excesses. And this Keynesian policy of stimulus trying to get us out of this, frankly, is going to make the problem worse.
Stephen Stanley was just on. He's the chief economist at RBS, and he was saying he's expecting a V-shaped recovery. One of the reasons he cited was because of pent-up consumer demand. Your argument is that just the consumer is too debt-laden to really help anything?
The consumer, we don't think, has pent-up demand. If anything, the consumer has pent-up supply in terms of his cars are fairly new. People have spent like gangbusters over the last 5 years, keep up with the Joneses. As David Rosenberg has said in the past, we've gone from frivolity to frugality. People used to go out to eat a lot. It's no longer as cool as it used to be to spend like you have in the past. And if anything, that we've changed the culture.
David, a quick question for you. Do you see a danger in this sort of self-reaffirming view that people begin to have of equity markets, in as much as they see companies beating estimates, they see equity markets rising, they begin to feel as though everything's okay, there's nothing wrong with sort of the reflation trade? Where could that take us?
Well, certainly, you look at the pundits, all of Wall Street, policymakers, the media, you know, they want advertising revenue to go up. They want people to spend money again. Bob McTeer from the Dallas Fed said back in 2002, everything would be all right if we all hold hands and buy a new SUV. However, I think we need to move away from this consumer-driven, you know, culture to producing. Why is it we call all individuals
consumers? That's a hard habit
consumers?
to break, David.
Why don't we call us producers?
I was going to say, even if people are paring back and being a little bit more conservative in their spending right now, I mean, the American consumer is notorious for spending. I mean, since World War II, I should say.
He is, but the U.S. consumer has had a diminution of net worth like we've never seen. I mean, the numbers were in the range of 20% at the March low. Certainly, equities have recovered since then. Real estate is still down a lot. You know, there's been indication that, you know, pension funds really ended up not, you know, buying in back into March, ended up being sellers and just buying recently. There's just such a huge diminution of value that's going to impair spending.
David, since you're a bear, I have to ask you, what are you bullish on? I read a little note here that you do like gold and silver. So if a bear likes something, we have to listen up. Why do you like these?
Well, we love resources and especially precious metals, and that's because Ben Bernanke is widely referred to as Helicopter Ben. We're utilizing quantitative easing. We're buying treasury securities in the open market from printing money, essentially. That's bad for the currency. The Chinese are worried about it, the Russians, the BRIC countries, etc. We think you should protect yourself, and gold and silver will be a vigilante against that.
All right, David, because you've been good enough to come into the studio, I think we're going to keep you, if you don't mind, through this commercial break. So we are back with a little bit more with David Tice from Federated in just a few moments.
Stay tuned. We'll be right back. We are back now with David Tice, Chief Portfolio Strategist for Bear Markets at Federated Investors, a man known as the Prudent Bear. David, a question for you. You talked about valuations. I know you cannot say specifically what you're shorting. The rules that you operate under prevent you from doing that, even on a sector basis. But going through the industries represented in the S&P 500, where are valuations way too frothy in your mind?
Well, frankly, Eric, we think a lot of bad companies have risen the most in this 50% decline off the bottom. And cyclicals are up a lot. Financials are up a lot. Tech up some 40%. All those companies we think will fall a long way when this market rolls over again. Frankly, this rally was not unexpected. After a big decline like we had, it's not unexpected to have a big rally. We went to a Fibonacci level at 1,011. We could turn any day. We could rally a little bit from here. Our timing isn't as precise as we'd love it to be. A lot of people have got optimistic. However, we've never been more confident in our life that we're going to test and break through lows eventually.
David, when you say a lot of bad companies have risen, are you judging by their debt levels? Because we do know that a lot of the companies that have a lot of debt on their balance sheets are some of the stocks that have outperformed. Is that what you mean?
Oh, exactly. I mean, companies that are very leveraged, companies like AIG, et cetera, that have had huge runs. Frankly, if you try to short stocks, any stock that has a good short story have tended to increase more than, better companies, frankly.
Let's talk about technicals for a moment, because you mentioned getting to 1011 on the Fibonacci sequence. I read a note from the chief market strategist at Royal Bank of Scotland, Bob Janjua, yesterday, saying that if the S&P 500 closes above 1,022 for 4 days in a row, it is time to head for the exits. Do you see, are you prepared to make a similar prediction that at that level, it's time to run?
Well, our level of granularity isn't as precise as Bob's. However, this market's come a long way. We've gotten a lot of bulls. You look at the AAII numbers are at, extremes now. A lot of bulls, very few bears. Virtually everybody's optimistic. I don't really see it going much higher than 1,030, 1,050, and I would certainly be putting on shorts if we got much higher than this, for sure.
So you'd be hedged against that move higher?
Yes.
What are some of the other strategies you could employ? I mean, if you want to keep your foot in both sides, would you go out and buy some out of the money puts, perhaps?
Oh, puts are great. There's other puts on individual stocks, puts on indices, being short futures. Most individuals are scared about being short. However, they should realize they have 3 legs to their financial stool: stocks they own, the real estate they own, and their paycheck and bonus. All 3 of those legs go down in a big decline. You should offset that with negative correlation.
David, always glad to have you with us. Thanks so much for coming in.
Glad to be here. Thanks for having me.
David
you guys keep up the
Tice,
great work.
Thank you. Federated Investors.